So I think let's get started. So welcome everyone to the check-in meeting. Thanks very much for making the time. Mike, I'm glad to see you. You rushed back from your dinner. I was all ready to give your sort of apologies for the first part of the meeting, but it's good to see you there. I think the only formal apology we've got for the meeting today is from Hervé Adrien, who's got some difficult clashes, so he's not able to join us. I think Thomas Moller-Marquesberger will join us a little bit later. He's got a client meeting, although I know he's around because he and I have just been in the IPSASB working group meeting where both of us presented this morning, or this morning Europe time. So I know he's around, but he'll be just slightly late joining us. The main discussion item this morning will be on transfer expenses, but before we get into that, one piece of news to share with board members and TAs is obviously we had the discussion last time around on the projects that we're going to propose adding, and we had the discussion about our positioning on sustainability reporting, and we recognised at that stage that it's a very active area at the moment. Since the last meeting, based on the sort of direction that the board gave, which was to engage with the developments around the creation of the Sustainability Standards Board, but not to get ahead of that process. I think it's worthwhile recording the fact that you know, we've had a number of discussions, and as a result of that, I can confirm that the board is going to be there are working groups that have been formed to take forward both the organisational arrangements and also to begin to think about the shape of the guidance going forwards. And those groups involve both the existing 5 sustainability standard setting reporters, IPSASB, IRC, what are they? CDSB, GRI, and there's another one, I think, but CEP, I think maybe. Anyhow, those groups are all in the room, as are ISB, and IOSCO will be an observer, and IPSASB will be observers, formal observers on those 2 working groups, so that we can share the public sector perspective and input into those discussions about the formation of that Sustainability Standards Board and its thinking in terms of guidance going forwards, which I think we're pleased about as it enables us to input to what's a very important piece of development in terms of the reporting landscape internationally. So I just wanted to share that with you, and that really, after a number of discussions with the IFRS Foundation, that came to fruition last week. The other thing just to report in that space is Ross and I have also been having discussions with people in the World Bank who are looking at the task force on climate financial disclosures and the applicability of those to sovereigns, and we're inputting to a report that they're developing at the moment. So quite a lot that's happened since we last met. You'll also see, I hope in the next few weeks, that there will be some sort of positioning communication with regards to the importance of sustainability in the public sector, but also positioning the fact that we've got existing guidance, which is very relevant in terms of RPG1 on long-term financial sustainability and RPG3 in particular on service performance reporting. So there's quite a lot that's actually been going on since last time round and is going on at the moment, but I think that's all consistent with the direction that the board agreed last time round. So just pause and let if anybody wants to comment on that. Lynn?
Thanks, Ian. I think that is all really, really welcome. Will the board get a sort of report back at each of its meetings from that work, or will we have it periodically reported back? There's been quite a lot of interest from board members in this agenda, so it'd be good just to understand that sort of report back mechanism.
Thanks, Lynn. I think that's a very good point. To be honest, actually, we hadn't formalised that, but I think, as you say, I mean, it's a very important development, and I think, Ross, I think that's something that we can include. We'll work out where that comes, whether that's part of your report or it's a separate item, but you're right, Lynn, we should report back on that. And we did also talk about the communication more broadly with our stakeholders, and again, we've got some work to do to think about that. But I think that's certainly that's good action to take away. Adrienne.
Just a comment on a trend that I'm beginning to see, which is this criticism that the public sector is moving more slowly. So, for example, particularly that state enterprises haven't been a big part of the discussion of sustainability standards. So, at some stage, you might consider stopping being an observer and joining the working group, so that we can say that we're not part of the criticism of the public sector moving too slowly. Just a thought.
Yeah, no, I mean, I think the positioning in terms of being an observer is probably right, in terms of it allows us to contribute without necessarily being asked to commit resources, which some of the others will be. And given our constraints on resources, I think that works. But I think you're right in terms of visibility, and that's really one of the things that we've been talking to IFAC's communications advisors, Edelman, and this is where the article, I think, is the start of a communication campaign, because I think one of the things, going to your point, is actually I think governments should be thinking very actively about this and what they do, and actually not waiting. You know, a lot of this is actually about they need plans. You know, I mean, they've committed to targets, as we've seen in the last week or two. So what are their plans to deliver that? And there is no reason not to go ahead and start to do this. You know, they don't need to wait for perfection in terms of the reporting. The reporting is the back end of this. It's actually just get on and do it. And that's certainly what I've said in the couple of events I've spoken at. And I think that's, you know, one of the messages that I would hope we can get through in terms of the communication, and really start to sort of try and raise the profile. And I think if members see opportunities for that, then I think, you know, if you can get in touch with, you know, with Ross and I, and then we can see how we can, you know, I think we need to be careful not to start setting guidance too early, but I think we can certainly do our part in terms of raising awareness. Okay. So we'll keep, as Lynn's requested, we will keep the board posted and make sure you're up to date. And if there is anything in particular that comes out between our meetings, then obviously we'll keep you posted on that as well. Russ, anything else from you on that?
No, Ian, I think you've covered it well. And I think to Lynn's point, I think it does make sense that we have some reporting mechanism to update on that process back to the board. Okay, that's great. So then what we'll do now is then move into the session on transfer expenses. And obviously what we've done is to say we've got a lot of comments to work our way through, 200 across ED 70, 71 and 72. In March, we focused on the revenue side of things in terms of discussing the way forward on the 2 revenue EDs. And this session that we're now going to have is actually the first time we've really got an opportunity to focus on the transfer expenses ED 72 and the way forward on that. Recognising this is an area where actually we
probably had more criticism of our proposals. It's also of the three, the area where we're providing guidance for the first time. So what we've got is actually a longer session, and I think that addresses comments received from board members that they wanted some more time on what's a fundamental area where we're providing new guidance. So we have got the whole of this morning for the initial discussion, and obviously it is just the initial discussion. You'll note that as we go through, very definitely is an opportunity for debate and discussion. So whereas in the past, in order to move through materials, we've focused on asking members if they disagree with staff recommendations, you'll see that the formulation in terms of the requests is actually, do you agree? And it's there so that people have time to debate and discuss. And also, you know, I've asked staff to try and be you know, kind of not to move too far before allowing the board opportunities to debate and discuss. So there will be plenty of opportunities for debate and discussion as we move through. In terms of organisation of the discussion, I think it obviously depends how we move through the material, but broadly speaking, you know, the first half will be you know, we'll split it half and half, and we'll take a break at an appropriate point in time. So there'll be the usual sort of 10 to 15 minute break at an appropriate point. I think with that, probably what I'll do is hand over to Eileen, who is going to take us through the first part of the agenda, and then Paul will take us through the second part of the agenda when we move into discussion of executory contract accounting principles. So Eileen, over to you first.
Thank you, Chair. So hello, everyone, and thank you for your time today. As the Chair mentioned, today's session is going to focus on transfer expenses. Now, the transfer expense project was formally approved as part of the IPSASB's 2015 strategy and work plan. And as board members may recall, staff presented a high-level summary of the responses to the revenue and the transfer expense exposure drafts in December. Since then, staff has spent considerable time conducting a detailed review and analysis of the 65 comment letters that we have received in response to ED 72 transfer expenses. Now, during this process, we ensured to consider both past board decisions, which you'll see here summarized on the slide, and also to consider that together with the constituent feedback as we conduct our analysis and progress towards the final pronouncement. Now, based on staff's review, a majority of respondents did agree or partially agree with the SMCs that were proposed. However, when we took a step back and looked at all of the comments, we did note that some responses highlighted potential conceptual flaws in specific components of the proposed transfer expense accounting model that would require further consideration. Several issues are also dependent on the resolution of other higher level issues, and some issues can also be informed or addressed by previous IPSASB decisions. So with these considerations in mind, staff came up with a list of issue papers and overall project plan, and this plan is to really help put a path forward for us in terms of reviewing, assessing, and discussing these key issues. And we'll be going into this in further detail in the next agenda item. Now, while there was no decision required for this project overview paper, we're happy to pause here for any questions that members may have before we proceed with the two main discussions for today's session.
Thanks for that short intro. Any points anybody wants to make at this stage? No? Okay. So move forward, Eileen.
Yep. Just going to share my screen here again. So the first topic for today is about addressing the key issues identified in responses to ED 72. Now, as mentioned in the earlier agenda item, staff did note from our detailed review that some comment letters highlighted a few potential conceptual flaws in the proposed accounting model, and specifically their inconsistencies with the accounting principles. So taking a step back, staff did acknowledge that the transfer expense project has been closely related with the revenue project, and that the board's intention throughout the life of both projects is to be consistent with the accounting proposed in both projects for similar transactions. Now, specifically, the intention is to be consistent in principles, as IPSAS is a principle-based suite of standards. Now, with this in mind, staff noted that some of the transfer expense issues can be informed or addressed by decisions that the board has made in the revenue project during the December and the March sessions. Considering these decisions will actually help the board to achieve consistency of principles for similar transactions, and also to determine the appropriate path forward to resolve constituent concerns. Staff has considered the potential implications of these revenue decisions and provided the analysis in Appendix 1 of the paper. And the purpose of today's discussion is to consider and discuss each of the 7 implications for transfer expenses that we've proposed in Appendix 1. We will be going through each implication or takeaway from the revenue decisions and how they may impact transfer expenses over the next few slides. Now, as a gentle reminder, as the chair noted at the beginning of the session today, we have revised the questions to the board to help facilitate a more robust discussion on each item. And the agreement of each implication that we're going to present to you does not necessarily close an issue, but rather this feedback is on the implications is going to help give staff a general direction on how we're going to proceed with the detailed analysis for each issue in the coming sessions. So I'm just going to take a pause here for any questions at this time before we start with the first implication.
Okay, not seeing any hands raised, so I think going to the first issue there, please, Eileen.
Yep. So the first issue, implication that we've presented here is related to presentation. Now, the IPSASB has made several decisions during December and March in the revenue project, which included reordering the guidance to begin with ED 71, taking a principle-based approach and focusing on the nature and risks of transactions, and also revising the title of the standard to better reflect the nature of the transactions in the public sector. Now, on the revenue side, because we had initially proposed two standards as well, for the time being, we had decided to present this guidance as 2 separate standards. Now, when we think about the implications for transfer expenses, we think that the same conceptual takeaway is still appropriate for transfer expenses to present the standard in a way that reflects the public sector. This means that we may need to reorder some of the guidance within the proposed ED 72 to begin with principles related to transactions that are more prevalent in the public sector, so specifically non-exchange type transactions. Staff are also of the view that the title itself does not necessarily need revision, as the current title does reflect the scope of the transactions that would fall within this proposed standard. So the question that we have for the board is, does the IPSASB agree that the presentation of the transfer expense standard should also reflect the public sector?
Thanks, Eileen. So, comments from members on that proposal? Yeah, Lynn, go ahead.
Thanks, Ian, and thanks, Eileen. There were quite a few comments that constituents raised around title and scope. I'm conscious that the presentation has just asked us around the ordering within the ultimate standard. So I guess in terms of the presentation question, it would make sense to me to start the standard with the transactions that are the most prevalent, but it seems almost premature to discuss that. That seemed a common sense thing to me. There seem to be a lot of issues that we need to agree principles on, and maybe we'll come to those in terms of scope and distinction, for example, between present and performance obligations. But I guess in terms of the answers to the questions, in principle, yes, let's start with the transactions most prevalent, but I do think we ought to just consider title and scope and not necessarily make a firm decision, because when I looked at the constituents' comments, there was quite a few in terms of title and scope.
Other comments from members? Okay, so I think, you know, that seems to me then that members generally support the sort of reordering of material that we've agreed for revenue. That's helpful going forward. I think there are two issues here then, picking up your other comments, Lynn, on scope and title. On scope, I think certainly you're right, there are a number of questions from constituents on how this relates into other pieces of guidance, the conceptual framework, IPSAS 19 and so on. And I think, so there's clearly some communication that's required. I think we need as a board to guard against changing the scope unnecessarily, unless there's anything that comes through, because we've seen a history of basically unforeseen consequences when we expand scope. There certainly is a potential to expand the scope here, you know, and comments were made about applicability to other forms of expenditure and so on. But in terms of actually maintaining the deliverability, I think unless anybody really comes up with a fatal flaw on scope, we should not expand the scope. And we did have quite a lot of discussions first time round about what transfer expenses actually were. So on scope, I think the instruction to staff would be, you know, unless there is a fatal flaw, what we should be concentrating on is better communication in that area. And then, consistent with your point, Lynn, we would need to come back and see whether there's a need for a change in title when we've got further in, which would be consistent with what we've done on revenue. But perhaps if we use that as a working, we keep the working title as transfer expenses at the moment, and then come back and take a final decision when we're further through. Is that okay as a way forward? Okay. Good. So I think, you know, probably the ordering of material, that's a decision consistent with what we've done previously, and then the other two areas would be instructions for now. Okay, so Eileen, move us into the next area.
And I've shared takeaway 2 on the slide. And just as an addition to what Ian has said so far for the scoping matter, Lynn, we have currently planned for a paper later on that's going to relate to those scoping commentary from constituents. So it's on our radar for sure. But as Ian said, we have the takeaway of keeping it in mind and having it as a working title and reassessing later. So we'll definitely keep that in mind. Now for takeaway 2, which is presented on this current slide, this is relating to binding arrangements as a fundamental concept for the revenue as well as the transfer expense standards. So this is a decision that the IPSASB made during the March session when we discussed revenue, and staff are of the view that binding arrangements should also remain as a fundamental concept in transfer expense accounting. This is because transactions arising from binding arrangements are different in nature, and there is a level of accountability relating to the rights and obligations attached, and this impacts the recognition of the transactions themselves. Retaining this concept would be important to help constituents to better understand the application of proposed accounting and to properly reflect the nature of the transaction and the economic events related to those transactions. So the question that we have for the board is, does the IPSASB agree that the binding arrangement should remain a fundamental concept for transfer expense accounting?
Thanks, Eileen. So open up for comments or discussion on that. Yeah, Mike, and then Todd.
Thanks, Chair. I'm using an iPad, so it's a bit slower than normal. Look, thank you. So I agree the principle that you're putting forward, but when I read the papers, I seem to get the impression that that was then leading us automatically to symmetry. And I don't think it should be leading us automatically to symmetry. Because somebody accounts for something, a revenue in one particular way, doesn't mean that the resource provider's got to do a symmetrical piece of accounting. So I just want to make sure we're not leading in that direction unnecessarily.
Todd?
Thanks, Ian. Yes, I'd support what Mike has just said in terms of the symmetry angle. In terms of the question that's been asked, it certainly makes sense if, binding arrangement is quite fundamental to revenue. It has to be for the other side of the transaction. I suppose, in thinking about this, we have defined binding arrangement in a particular way, and I think it's just important to be clear, particularly for newer members of the board, that when we're talking about binding arrangement, it isn't the way that it's defined in the conceptual framework. We have specifically defined binding arrangement as part of the suite of standards here. And probably one of the things that hadn't come through in looking at the Appendix 1, I think we talked about binding arrangement. There needs to be a sufficient level of specificity or distinction in terms of what is required under the binding arrangement to be able to account both for the revenue and the expense in the sorts of ways that we're sort of alluding to here. So just wanted to reinforce that, and particularly for some of our newer members.
I think I muted myself. So carry on round. So go to Mark next.
I agreed in the last meeting we made some important decisions and deliberations on what constitutes a binding arrangement, and therefore I appreciate the staff paper that this thinking has been brought forward, and I think it's right to bring this thinking about binding arrangements forward to this paper. Of course, we will see in the next chapter on executive contracts that somehow a symmetry is implicit in, because you have a binding arrangement of two parties and rights and obligations. However, I still share the opinion that not necessarily we'll have to end up in symmetry, but maybe not because of it's not conceptually symmetric, but because we might end up saying it's a too big burden for the transfer provider to monitor the satisfaction. So we already did that in saying if the provider intends to monitor the progress. So I could still imagine having such a kind of restriction, then weakening the symmetry. But as from a conceptual point of view and applying, and I think the papers really sorted that out very well. I think there is some kind of symmetry in the whole conceptual thinking.
Thanks, Mark. So I'm hearing support for, and I think, Mark, it's quite useful, the distinction that you made between conceptual and practical in this area. I mean, I'm getting a sense that, from a conceptual point of view, members are supporting that we had the discussion on the nature of the binding arrangement. As you pointed out, Mark, there are two sides in the binding arrangement, and therefore it makes sense that that conceptual thinking is reflected in transfer expenses and on the revenue side. Clearly, as you say, there are some differences in practice in terms of how that might play out. We will need to be careful as a board in terms of how we take that forward, because I know you have quite a few situations where you have streams of funding that move between different levels, and therefore what's expenditure at one level is income at another level, and so on. And that probably goes to your point again, Mark, about the guidance, the principles being consistent between the levels. Then how that works out in practice is clearly going to be another matter that's dependent on the requirements within the agreements. So we're going to need to keep managing that. Lindy.
Yes, thanks, Chair. And I guess linked to that, we would have to also test and think that there could be arrangement when government make transfers to entities that don't apply IPSAS. Especially where it's development finance, for example. So it's not always going to be between entities that apply IPSAS. So they would be thinking of a contract possibly on the one side and a binding arrangement on the other side. And we probably just test the thinking that there would somehow be some consistency. And if not, then we would know where that is or isn't. Thanks.
Thanks, Lindy. Lynn.
So I think my comment is probably going back almost to support what Mike said, which was around binding arrangements. Each party to the binding arrangement at any point in time will have to assess how they view the rights and obligations and account for them based on their assessment. And I don't think we should be sitting here saying that the assessment of each party has to be the same. That's clearly each party needs to assess their own position and account accordingly. So I think we need to be really careful that we don't set ourselves a principle that suddenly says they have to make the same assessment and achieve symmetry, because at a principled level, to my mind, that has to be wrong. The reporting entity has to assess its rights and obligations in any binding arrangement and account accordingly.
Thanks, Lynn. And I think that's why we need to keep that distinction in mind between the concepts being consistent, but actually, as you say, there will need to be assessments made on either side, and we cannot, as a standard setter, mandate symmetrical treatments. We can provide consistent guidance on how to approach those assessments, and that probably is what we should be thinking about. But we can't mandate for, Lindy has said, it may be different frameworks apply, different organizations, different auditors, and so on. So we can't mandate that. Ross, you wanted to come in, and then I'll go back to Mike.
Yeah, I did, because I think this has been a helpful discussion from the staff perspective, because I think the board's going around a lot of the points we discussed when this paper was being developed. And I just want to bring it back to what's in the paper. All that's proposed in the paper now is consistency in the concept. We're not getting into the application of that concept yet. And I think from a staff perspective, I would agree with all the points. And that's why we haven't talked about symmetry. Because in matter of fact, when you're applying this standard and applying the binding arrangement concept, as Lynn and Mike have both said, you have to look at the perspective of the entity applying the accounting to the agreement. And because you have consistency in concepts does not mean you have consistency and outcome and accounting between the two. They're two independent reporting entity assessments of their rights and obligations in the agreement. The reason we're bringing this concept is because if you look at ED 72 now as proposed, we weren't consistent in the concepts. We had a different concept for transfer expenses with performance obligations that was separate and distinct from what was proposed for binding arrangements with performance obligations, and it was inconsistent with what we proposed on the revenue side. So that's why this is being brought. So what we're looking for here is just that the thinking on binding arrangement and that concept can be brought over, and we think through the impact on ED 72, because that would be a change from what was proposed. And agree with all the points on symmetry. We shouldn't be jumping to the conclusion that that means symmetry, because I think that would be us writing rules rather than principles. What we're saying from a principle perspective is let's get the concept right, then we'll think through what needs to go in the standard to help people to apply it from their perspective in the transaction. Thank you.
Thanks, Ross. And I think that that addresses the point Mike was going to make. So I think if we have that understanding as a board and with staff going forwards, that what we're talking about in these discussions is conceptual consistency. We're not talking about symmetry in terms of, you know, from a practical perspective. And if we take that as read, that in a practical sense, for any of these transactions, when looked at, it will need to be looked at from the perspective of the entity applying the guidance and the discussions that they will have with their auditors. So it's conceptual consistency that we're talking about throughout these discussions. Okay, but I think, as Ross said, I think that's been very useful to have that discussion at this point in time. And it is in particular with ED72, we weren't conceptually consistent. So we do need to address that, and we will do later on in the discussion. For now, I'm sensing, though, that members are happy with the conceptual consistency then in terms of binding arrangements and the implications of the read across then on that from revenue from last time. Okay, so then Eileen, if you can move us into the next issue, please.
So this moves us on to takeaway C, and this is where we start talking about the consistency in principles. So this one is regarding having at least one present obligation in a binding arrangement. Now, during the March session, we did discuss binding arrangements at length, and two of the decisions that came out of the March session was that enforceability can arise from various mechanisms, so long as they provide the entity with the ability to enforce the arrangement and hold the parties accountable to satisfying the obligations. The second decision was that the existence of rights and obligations within a binding arrangement and the enforceability of the binding arrangement means that it contains at least one present obligation. Now, when we consider this as an implication for transfer expenses, staff are of the view that enforceability of rights and obligations in a binding arrangement would also give rise to at least one present obligation from the transfer provider's perspective. So in this sense, it's a consistency in the principle between the two entities here. So the question for the board here is, does the IPSASB agree that the enforceability of rights and obligations in a binding arrangement would also give rise to at least one present obligation for the transfer expense accounting?
Thanks, Eileen. Comments? Yeah, Camira.
Thanks, Chair. Well, I just have a question, just to, if the staff can clarify us. When we are talking here about present obligation, we are referring from the transfer provider perspective, not from the transfer recipient perspective, because it's confusing. Also, in relation with the other exposure draft, we always, for revenue, we always refer to the present obligation, but from the transfer recipient perspective, not from the transfer provider. So even the definition is from that perspective. So if you can clarify it a bit, thanks.
Thanks, Camira. Eileen?
Yep, happy to clarify, Camira. So the way we've defined present obligation would mean that there's little or no alternative to avoid an outflow of resources. And when we step back and think about binding arrangement in general, at least two parties within that binding arrangement would each have rights and obligations. And so from the transfer provider perspective, they would also have an obligation within the binding arrangement itself. We will be going into a bit more of that detail too in the next paper regarding executive contract accounting principles. So that might be an area where we can clarify further for you. But when we think about the definition of a present obligation as we have currently presented it, we do believe that is still consistent from both entities' perspectives.
Okay, thanks for that clarification, Eileen. So go to Mike and then to Lindy.
Thanks, Chair. So I think I'm just extending or clarifying what Camira's just said. So the way I read it is that that in a binding arrangement, at least one present obligation exists for each of the two parties. Is that what you're saying? And maybe we should document it that way.
Thanks, Mike. Go to Lindy and then I'll go back to Eileen for responses.
Yeah, so I thank you. I agree with what Mike said. I think it's quite easier to identify and agree that there could be a present obligation for the transferor. So I would agree with that. I think where you look at if there's an asset, it's probably where it gets a bit more complicated. So I definitely agree that there would be a present obligation for the transfer according in terms of the binding arrangement, because that would be the transfer of the cash at some point. On the other side, it's a problem. The asset is also a challenge, but definitely the liability is the easy one to identify for the transferor.
Thanks, Lindy. So I'm seeing support for members for making that clarification. Eileen, from staff side?
Yeah, generally I would agree, and I take that it's a helpful point that we should clarify that it's also from the perspective of a transfer provider. So we'll take that into consideration when we propose any revisions or additions to guidance to make sure that we are clear and succinct on this point. So thank you, members, for your comments.
Okay. Mike, you just wanted to come back in.
I just wanted to, in my mind, work out though what that present obligation for the transfer provider might look like. Obviously that organisation or that person's got an obligation to provide funding. But is there any more than that? Is it then to monitor, to do a whole bunch of other things? I think it's more than just providing the funding, but that will depend on the agreement, I suppose.
Could we come back and have a bit more of a discussion on that, Mike, when we go into the item on executory contract accounting principles? Because I think that's going to, we'll be talking about that a bit more then. Adrienne.
I'm finding it somewhat difficult to envisage how this works. For me, the transfer provider is the higher level of government. And my interest in all of this has been to say that you can never put the higher level of government in a binding arrangement. So this, because it's subject to all these budget restrictions and rules about the ability to change the budget at any time, depending a little bit on appropriations. And so this this type of binding arrangement from the perspective of the higher level of government would be very unusual. In this discussion, I'm losing sight of whether, from the accounting perspective, you're seeing this as very unusual, or whether you're envisaging it applying to a lot of transactions. So I just to raise the issue of whether you see this as central to the transfer, to the higher level of government that is providing transfers, or to a very small subset of transactions. So it's a question.
So, I mean, I think the idea is transfer, and if you look at what governments have been doing over the last year or so, essentially they have been incurring transfer expenses. They've made huge transfers. And the question then is going to be, well, is there a binding arrangement or is there not? Because if there isn't a binding arrangement, then they've just transferred the money, without obligations to a lower level of government. And that may well be the case. But the idea is that this would apply to quite a range of transactions. Now, the question is, does the principle hold true rather than necessarily the details of the mechanics? And we're going to have to come back and look at where you've got multiple different things coming into an arrangement, but we're trying to take the top-down principle here. So, Adrienne, back on that, and then I'll go to Eileen.
It's just, again, a query about what you just said, Ian. what I interpret from what you just said is that the binding arrangement is on the receiver and not on the higher level of government that's promised to give them money. So I just want to make sure I understand who's Camara's question. Are we talking about the receiver, or are we talking about the provider?
In this context, we're talking about the person making the transfer, but what we've agreed already as a board is that there needs to be conceptual consistency in the guidance. And what we're talking about here is if there's a binding arrangement, you have a present obligation. If it's binding if there's a present obligation to the recipient, then there's also a present obligation to the transferor. Eileen, help us out on this one, and then I'll take other comments.
Yeah, happy to jump in here. And I think when listening to Adrian's comments, the first thing that struck me was really the ordering of how we think through the transaction and how the entity would conduct the analysis. And I think there absolutely are cases where the higher level government may not be able to enforce any obligations or their rights. And I think just to clarify here, when we do talk about this takeaway of there being at least one present obligation, this is secondary to actually identifying if there is a binding arrangement. So if there's no ability to enforce the terms and conditions within the arrangement itself, then it wouldn't be a binding arrangement as we've defined it under the revenue and the transfer expense standards that we have right now. And in that case, there's obviously a slightly different accounting that we proposed. The present obligation really only arises once you've already made that assessment and conclusion that the arrangement itself is a binding arrangement. So it's sort of like a logical step-by-step as well of how this analysis would occur before we identify how exactly this transaction would be accounted for. So just wanted to clarify that in case it's helpful.
Thanks, Eileen, and I think we've got thumbs up from Adrienne on that, so that's helped. So then if I can go to Lynn and Mike.
So I do think all of that helps, but I think we do need to be really clear on expenses without binding arrangements. Are they in this standard? When do they interact and fall into another standard? So social benefits, for example, and that was some of the comments that came back about when am I in this standard? And I was just reflecting, Ian, on what you were saying in terms of what we saw particularly during COVID, is governments making announcements saying as soon as a business meets this criteria, you're going to get funding from a government. Now, is that a binding arrangement, or is that a benefit? Is that a expenditure without a binding arrangement? And so we do need to, whether or not that's guidance, but when we get to the end product, we definitely need to be clear about expenses without binding arrangements and which of those are in this finalized standard and where the boundaries are between this standard and other standards.
Thanks, Lynn. And I saw nods and support for that from members. And I think one of the things, just personally, that I had thought inevitably when we look at the examples and so on, we may well want to reflect on whether there are better examples based, unfortunately, on practical experience that we want to bring in as we finalise this. But you're absolutely right, we do need to think very carefully about scope. And I think we had experience of this when we finalised the guidance on collective and individual services, that we needed to be very clear about how we put that alongside social benefits. So I think that's a clear instruction that when we think about scope, we need to think about communication alongside that and what that means in terms of additional authoritative and non-authoritative material. So I think that's an instruction to staff when we bring that one back. Mike and then Todd.
So, Chair, thank you. I was just going to support your view about getting the concepts right first. And Adrienne, we do have in my jurisdiction a number of agreements between our federal government and our state governments, which are in the nature of binding agreements. So they do exist, and there are enforceable mechanisms in them. Whether those enforceable mechanisms ever then get applied is a different issue, but there are mechanisms.
Thanks, Mike. Todd.
Yeah, thanks, Ian. I think it's really good that we're having this discussion around what we mean by a binding arrangement, and I think I alluded to this earlier on in the conversation, and it's really important in my mind that we are aligned around our understanding of a binding arrangement here, because it, as I said earlier, it's not the conceptual framework definition. We are talking about arrangements where there are rights and obligations that both parties have to that binding arrangement. And just listening to Adrienne, I think whether or not there is a binding arrangement, it could differ between different jurisdictions or different entities. I know, thinking about a lot of the transactions that happen in New Zealand, I don't know whether many of those are going to be binding arrangements the way that we've defined them here. But I think where you do have arrangements that are binding arrangements the way that I believe that we have defined them here, that the sort of accounting that we're talking about is right. Yeah, but if people aren't clear on what we mean by binding arrangement, that's something that we need to work on here. And maybe it's helpful for these sorts of discussions that we're having, if we have, as part of the papers, even if it's repeating in paper after paper, just the appendix that just sets out the criteria that we have for binding arrangements. So what is it that we mean by binding arrangements? Because thinking back, it is about things like enforceability. It is about things like there's a sufficient level of distinction in what it is that's to be provided by one party and the other party, so that you actually have a basis for revenue accounting on the one side or expense accounting on the other.
Thanks, Todd. So I think, you know, you're entirely right in terms of we need to keep that consistency, keep reminding ourselves what a binding arrangement is and what's required in that. And the point that I think you made right up front about enforceability, we can set principles, but exactly how those play out will vary between jurisdictions. And I think we had some good discussions on that last time round. So we do need to be very clear about this is the way that binding arrangement is being used, this is what it means, and again, that's really what we're trying to test here, is that can we communicate that and can we follow that through logically, because if we can follow that through logically, then that will help our constituents. Eileen, did you want to, before I'm going to go back to Adrienne in a minute, and then Scott, was there anything you need to come in on first?
Yeah, I just wanted to remind the board as well that we had some instructions, like takeaways from the March session regarding binding arrangement. That is one of the reasons why we didn't put a formal definition and a very detailed appendix for this specific paper, because it is still something that staff is going to be revising and landing and to discuss in June. And this is definitely a kind of higher level comment, if you will, about all of the takeaways and implications we're presenting in this paper. It doesn't necessarily mean that the existing conversations have been closed, but more of at a point in time, at this current point in time, where do we see the implications for transfer expenses? And hopefully in June, when we fully land the binding arrangements discussion, then we can definitely bring this back in a complete way in the future as we talk about binding arrangements in the context of transfer expenses as well. But absolutely, I think, Todd, the point is very clear and helpful for us, but we are thinking about it.
Okay, so thanks for that, Eileen. So Adrienne, back to you and then to Scott. So
my question remains, I suppose it's scope. So on the one hand, Mike said his jurisdiction has a lot of binding arrangements, and then he followed it by saying something like, of course, we don't know which of these are really enforceable or not. And my conceptual worry is that our standards will get governments into being told by the courts that they have to enforce something that they can't enforce. And so in other words, the accounting suggests that there's an obligation that in fact it is contradictory to the way budgets work, that if the money isn't there, you can't give it. And governments have to be able to move around their resources so that the deficit doesn't get too big during the year. And I don't, from where it comes back to my fear that the tail is wagging the dog, that the amount of resources with binding arrangements it should be a very small proportion of total budgetary resources, and we're talking about it as if it's a big enough concept to be central to this discussion of transfers. Am I explaining myself properly?
So I think, Adrian, let's take a step back on this. So transfer expenses, we essentially put into accounting language what the expense side of transfers is for GFS deliberately, and we took that as the frame so that we started from that point of view. Now, essentially, the question is, if I make a transfer as a government, have I just given the money straight over? There are no obligations to meet in order to recognise that as income, or is there something there that I need to do before I can recognise it as income? That's the question, and that's where the binding arrangement question comes in. We're not making a judgment on the proportions of that at a jurisdiction level. That's for the jurisdiction to make a decision on. All we're doing here is actually being clear that in terms of reporting on the economic substance of the transaction, these are the principles that should be applied. How it's enforced, what the enforceability mechanisms are, if they exist at all, that's jurisdiction level. So we're not trying to dictate, we're just saying, if you do this in this way, it will have these consequences from a reporting mechanism point of view, if it's a transfer expense. So I hope that that's clear. We can't mandate for governments. They will make their decisions on budgets and and whether they add enforceability mechanisms or not. That's up to them. We're just saying, if you do it in this way, this will be the consequence from a financial reporting perspective, nothing more. Adrian, final comment.
Final comment. I'm from what you've said now, I see the obligation as only being on the receiver, and that's fine with me. But I'll listen and make sure that I'm understanding it right.
Okay, thanks. Scott, and then Murray.
Yeah, thank you, Ian. And some of the board members may be in the same place I'm in. I realized in reading this, I wasn't here on the board when this was drafted and came across. So to me, it was a catching up of where we were. But as I read this and I walked to the other side of the table to look at the transfer from the revenue side, and I'm really speaking in support of Todd on this, enforcement may look really different. And if we don't watch it, we're going to issue a standard that no one feels is binding. and so I could see when looking at this, depending on how we deal with the binding, that no one's going to implement this side of the standard, and because of the way they're going to interpret it. And so it would be helpful to me, and this is a plea on the next round, to have some examples. And I think the examples will help us with this, because I think at one level, enforceability makes sense, but when you come to the transfer side, I'm not sure the concepts are the same. And I'm speaking to Todd's point. So anyway, but I think some examples would be helpful, at least from my perspective. Thank you.
I mean, I think we'll get into some examples when we move into the executory contract side, but I think we have to be conceptually consistent. The facts of how this apply in practice is a jurisdiction level thing, but from a standard setting point of view, because of the fact that you have these layers of transactions in most jurisdictions, conceptually, we've got to be clear that actually there is a logic to this. So I think in our discussions, we've got to be clear, this is about concepts and consistency of concepts, how it applies, how the enforceability is, the enforceability mechanisms will play out differently between jurisdictions. We just need to set the principles. And that, and how that example therefore plays out in the US may well be different to how that example plays out in Austria or Japan or whatever, because of the legal framework. But what we have to do is say, these are the principles that will drive the reporting. That I think we've got to be really careful, and actually the problem that we've had all the way through this project is we've gone bottom up and we've looked at the detail rather than the principles, and actually that led us to the wrong answer, bluntly, on ED 72. So we've got to come top down on this. So we just need to be very careful on those examples that they don't, because you interpret them in one way in the US, will be different to another way. Mari.
Thank you. I would like to talk about the Japanese scene. Japanese higher government transfers so much resources to the lower level government, and so the transfer expenses so great issue for Japan. And so I'm very much interested in the performance obligation and transfer, how to measure the progress towards the complete satisfaction of performance obligation. And it is a great issue for issue the binding arrangement, and how to measure and how to recognize and how to monitor the progress and difference between the performance obligation and present obligation. It is a big issue for the Japanese scene. Thank you.
Thanks. So, I think that Mari's intervention there underlines this is a really important issue. We've got to get this right. From a conceptual point of view, we need to be consistent between levels. What came out earlier on was that the agreement amongst members that it was helpful to be clear that there would be a present obligation on both parties if you have a binding arrangement and it's enforceable. How that will play out is different in practice between jurisdictions, and may well be different between the transferee and the transferor, but the principles can be consistent, and we should clarify that present obligation, if there's a present obligation, it will be a present obligation for both parties. Okay, Eileen, does that give you what you need coming out of the discussion?
Yep, that's really helpful. Thank you, everyone.
And then I think, we need to be careful about examples going forwards, because they will be interpreted differently at jurisdiction levels. And if although the examples, going back to Lynn's point, we should think carefully about, are there particular examples from, pandemic interventions and so on. Those may well need to be come through more explicitly when we get into implementation examples and so on. But we do need to be very careful that fact patterns and different people's views on how they would work in different jurisdictions don't drive us away from being clear about the principles. Okay, so move us on to the next takeaway.
So the fourth takeaway that we have is regarding mechanisms of enforceability. And we have touched on this a little bit just in our immediately prior discussion on enforceability and binding arrangements. So two of the decisions that came out of the March session was that enforceability of a binding arrangement can arise from various mechanisms, so long as it holds the entity accountable gives the entity the ability to enforce the arrangement and hold the parties in the binding arrangement accountable to the stated obligations. The second decision that was very important here is that the entity must also assess all relevant factors to determine whether an arrangement is enforceable. This to me is where that discussion that we've had so far about the differences in jurisdiction and the fact that we need to do this on an entity-specific, jurisdiction-specific level is because there are so many factors that will vary based on the entity that is involved in the arrangements themselves. Now, if we think about the implications for transfer expenses, staff are of the view that they should be consistent, where enforceability of a binding arrangement from the transfer provider's perspective should also consider various mechanisms. So the transfer provider should consider all the relevant factors when they are assessing whether the arrangement itself is enforceable and thus a binding arrangement at transaction date. So our question for the board is, does the IPSASB agree that enforceability can be demonstrated by various mechanisms in transfer expense accounting and that all relevant factors should be considered in that analysis?
Thanks, Eileen. So open up for comments. So getting thumbs up from members. Lynn, you want to come in?
Yeah, so I am in the thumbs up camp. I do think, however, we should be clear, and we'll probably get to this later, that around, is it the existence of an enforceability mechanism, is that sufficient, or does there have to be a probability attached to it being exercised in practice? And I think we do need to be clear on that for our constituents as much as anything else. And I think what drives me to that is often on the expenses side, the enforceability is a clawback mechanism. If you don't do something, I'll claw the money back. And you might have a past history of never clawing back when somebody hasn't done something. So do I need to assess probability, or is it the fact that I have a right, is the existence of the right sufficient, or does there need to be a probability attached? And we could be clearer on that, and we ought to think about that from a principal's perspective.
Okay, so I think that's a clear instruction that we will need to consider and be explicit about that going forwards. Bernard, and then Mike. We're not hearing you, Bernard. Do you want to have another go? I'll go to Mike and then let you have a tinker at your end. Mike, go ahead.
Thanks, Ian, and I agree with Lynn. And Lynn, that reminds me of a discussion we had, I think, with a representative from the EU who spoke to us about 2 years ago about funding to the various governments in Europe, where there are very clear mechanisms to get the money back, and she demonstrated how that's done. So, but I suppose I'm just saying that there are mechanisms, and they do seem to work in some jurisdictions.
Thanks, Mike. Bernard, do you want to have another go? Perhaps the best thing would be to put it in the chat function or something like that if the sound's not working. Okay, so subject to what Bernard wants to say, I think support there from members for the principle that you put forward, that instruction that we will need to be clearer about if you've got a mechanism for enforcement, but you have a history of not having used it, how does that impact? That's an instruction that we need to staff need to come back with clear proposals on how we address that in future. Mike?
Yeah, Chair, I just wanted to remind us that we had a similar conversation either the last meeting or the one before, where we concluded that on the revenue side, there didn't need to be a history of enforcement. It was just the fact that there was an enforceable mechanism in the arrangement. So I don't want to go back, deliberate all that discussion, but that's where we landed on the revenue side. We may have a different view on the expense side, but that's where we landed, I think.
Thanks, Mike. It's helpful. Eileen, can I just go back to you on that one?
Yeah, I think I thought it might be a good time to just give a bit of clarification, because as Mike said, we did have a good discussion on past history in the last session, and where we landed was that it is a factor, but not a primary factor or anything that overrides others. Now, to Lynn's point, absolutely agree. We need to be clear about how we consider enforceability. And right now, the general viewpoint and where the board had seemed to land last time was that it's the ability to enforce and not necessarily the probability. Now, whether you have or have not in the past is something to consider in the overall analysis, but it is one of many relevant factors. And just so the board knows, because we have had those instructions on binding arrangement in general from revenue, we will be bringing back another paper in the future on the revenue side, which will of course also have implications for transfer expenses. And we'll make sure to be as clear as possible in that paper to address some of the concerns that were brought up today as well.
Okay, thanks, Eileen. I think it's helpful for that reminder, and I see thumbs up to that. So in principle, we would apply, sorry, I was just trying to read, I saw Bernard's chat came through. So we should apply the same on the transfer expense side as on the revenue, consistent with our decision on that. Sorry, I'll just have a look at. Right, okay, thanks for that point. So Bernard said, just wanted to add that this is a step-by-step process. Assessing the probability of fulfillment or enforceability is also part of subsequent measurement. Okay, so I think support there for the principle, that clarification from revenue helpful. And I think, probably when we're going through, therefore, it's going to be helpful to make sure that we do actually see the drafting from both perspectives, if we're talking about the principle and we're trying to be consistent. So I think that's probably something that we should do when these papers come back. So we do the drafting on binding arrangement and we're clear on what's going to go in, both from the revenue perspective, but also from the expense perspective. If that's okay. See nods on that. Okay, so move us on to the next takeaway, Eileen.
So the fifth takeaway is regarding enforceability giving rise to an asset for a transfer provider. Now, if we take a step back from the March discussion that we had on revenue, one of the key decisions that came out was that enforceability gives rise to a liability, specifically a deferred revenue liability, to the extent that the terms of the arrangement are not yet satisfied. Now, when the staff considered this in the view of transfer expenses, staff are of the view that enforceability would give rise to an asset for the transfer provider when the resources have already been provided, but the transfer recipient has not yet fulfilled its obligations within the arrangement. At that time, the recipient has not yet technically earned the revenue, and the provider has not yet incurred the expense and would still control the resources that they've already provided. So our question to the board is, does the IPSASB agree that enforceability would give rise to an asset for the transfer provider in such a circumstance?
Thanks, Eileen. So open up for comments. Yeah, go ahead, Mike.
So thank you, Eileen. This is where Bernard, I think's point is really valid. So I'm assuming the circumstance that you've described is one where the cash has been paid, say, but the recipient hasn't yet fulfilled the obligations. So the resource provider may have an asset, but then how do you measure that asset? And it may not be worth anything. So I struggle then with, I just want to make sure we then line up with what's in the conceptual framework. Do we meet the definition of an asset? Maybe. If yes, then how do we measure the asset? And I'm not sure that we've sort of fleshed that out.
Okay, thanks, Mike. So I'll carry on and take comments from Lynn and Lindy before going back to Eileen.
I just really wanted to echo what Mike said. I think you have to assess whether or not you've got an asset, and we need to be linking that to the conceptual framework. I think this was made too many assumptions, and maybe it's because it was example based, I don't know, but I think we need to land whether or not we've got an asset based on conceptual framework principles.
Okay, Lindy, and then I'll go back to you, Eileen.
Thank you. So I also struggled with identifying the asset. And I did look at what we said. We said previously, this is an asset that embodies service potential. And I don't know if that would always be the case. If you do have, if you can argue that you have, it links to what your operations are. So this is service potential, and you can enforce the other party to provide that service potential to you. And I struggled that this would be something that would be applicable in every single scenario. And so I do think we would have to possibly look at when you would have this. And I think this is what Lynn and Mike have already said. I don't think it's automatic. So, and then I was also thinking, well, would this be some sort of financial asset? And I think when you look at those definitions, it's really where you have an unconditional right. And I don't think that criteria has quite been met. So I don't think, yes, because you can enforce the arrangement, I don't think there's automatically an asset. I think we would have to describe the situations where there could possibly be one, and be quite specific in that regard. Thank you.
Sorry, Lindy, can I just explore that a little bit more before I go back? So you have something that's enforceable. So do you not control it? Is that the question? Because I'm struggling to think, well, what else is it?
And I think that is it. So can you, is it that you have this right to get the money back, that it's not performed, or is it that you have the right to force that party to actually deliver the service? Because if you go to court, is it that you're going to want the money back, or you want to force them to perform? So I'm struggling to identify what is it that you actually control. What is this asset? Is it the ability to instruct them to actually give you that service potential by delivering to the third party, or is it the right you have to the cash back? And I think possibly it depends on the terms of the binding arrangement. And
yeah, I think that probably there's strong resonances there into the discussion that we had last time around the nature of enforceability and what does that actually mean in practice. Perhaps go back to Eileen, and then I'll go to Mark, Kamira, and then Ajith.
Thanks, Chair. I thought it might be good to just point the board to the table that we have in the paper. We do have a paper planned about what gives rise to an asset for the transfer provider to explore it a little bit further. These implications that we are talking about today is a good direction for us. And absolutely agree, we can't immediately assume that there will be an asset in this circumstance, but it's sort of the general takeaway given the discussions we've had in revenue. Now, staff do recognize that that discussion is ongoing. The liability discussion we had in March did have a lot of discussion and takeaways that we will be exploring further in June, and that will have implications for us in transfer expenses as well. So we recognize that it's not a completely closed issue, and we will be bringing back further analysis.
Okay, thanks, Eileen, for that clarification. So then I'll take member comments from Mark, Camira, and then Ajith.
I think it has been already said as the existence of an asset deeply depends on the enforceability, and as we discussed last March, there must be some kind of an outflow or a repayment, but it's highly dependent on the jurisdiction. So I completely acknowledge in some jurisdictions there might be the conclusion there is no asset, while in others there can be. Just another aspect, I always compare it and look at it how it's in the performance obligation world, and there we have indeed a contract asset, a kind of prepayment, and I think that the difference is that we are not talking about a performance obligation because it's not a transfer of goods and service, but it's still a transfer of money to a third party, and in the performance obligation approach we also have the possibility that the transfer is not back to the transfer provider, but to a beneficiary. And still we come up and say, and this also links to the next agenda, we're talking executive contract. If you have prepaid, have you actually prepaid it, or is it already an expense? And I think I struggle to see why to say in the performance obligation approach we have an asset clearly, but in the present obligation approach here, there cannot be an asset. I think it really depends on the binding arrangement imposing the obligations.
Thanks, Mark. And you're right, yes, there is a bit of sort of overlap with the discussion we're going to have going forwards. So to Camira and then to Ajith, and then I'll go back to staff.
Thanks, Chair. Just to follow up on Lindy's comment, and also trying to recall some of the comments from the Latin American countries in the FOCAL, what for them was important was the distinction in the transfer expenses, whether this transfer was conditioned or subject to repayment or refund, because in that case, some of the comments of these countries they mentioned that if that transfer expense was refundable, there was this enforceability, and there they would agree recognizing as an asset. For the other cases, not. So that was the example of the Latin American countries. Thanks.
Thanks, Camira. That's very helpful to be reminded of what constituents said. Ajith.
Yeah, thanks, Ian. It appears to me that in the case of where the eventual expense would come within the purview of the transferor, then it would form an asset, because that expense is something that that transferor will want to make in servicing its own obligations. In that situation, I believe it would form an asset.
Thanks, Ajith. So, I mean, I'm sensing from members' comments. I mean, I think, you know, as Eileen said, we've got further to go on this, but I think clearly the view that the board takes does need to be grounded in the definition of an asset and what is taken and what is required in order to recognise an asset in the conceptual, you know, in terms of the guidance in the conceptual framework. Then looking at this, then, and that's where, you know, enforceability is going to be really important. And that's where the discussions that we had on the liability side, obviously last time round, come through on and will need to be reflected here. As Camira said, I think it's easier to see the arguments, and this is what constituents in Latin America, for example, it's easier to make the argument where you actually have cash than the ability to enforce performance going forwards, and that may well be the area that we need to have a look at, it more particularly from the conceptual side, but also in terms of how that works from an enforceability perspective, and so on. So there's a nest of issues there, I think, that need to be explored, but it's that performance side which is probably giving the board most concerns as to whether that meets the definition of an asset, and it's clearly something from our constituents' point of view that's where there's a particular problem that we need to address. Eileen, back to you at that stage. Does that give you enough to move forward with this? Clearly, we need to get, this is where we need to see the drafting coming out of the decisions and instructions that the board's already made.
Yeah, thank you, Chair, and thanks, members, for the comments. They are definitely very helpful, and we'll make sure to keep them in mind when we're presenting the binding arrangement paper for revenue in June, and also how we take it forward in transfer expenses when we further assess these specific issues. But they're really helpful comments, so thank you, everyone.
Okay. Thanks for that, Eileen. And I think we have to recognise this is one of the really tough areas. But it's really important that we get clarity over the guidance. Okay, so move us on then to the next issue.
Okay, so this is the 6th takeaway listed on Appendix 1, and it's regarding the distinction of performance obligations. Now, in the March session, we did discuss in significant detail about how performance obligations differ from present obligations. And where the board landed with its decisions is that the revenue from performance obligations would still be retained as a separate type of revenue, and that these performance obligations are a subset of present obligations that embody a specific transfer of a distinct good or service to a purchaser or a third party. Now, when staff were considering this, given constituent comments and in the context of transfer expenses, one of the preliminary views that we came up with was that performance obligations would still differ from present obligations by nature under transfer expense accounting, but this distinction doesn't seem to appear as useful for transfer providers as it does for revenue from the revenue perspective. And so while we do have this preliminary view that the performance obligations do still stay as different from present obligations, further analysis will be required on whether we maintain this distinction within the transfer expense accounting and the standard itself, or if we will take that away and change the standard accordingly. So this is definitely an area where we believe that it will require further board discussions and thinking before taking it forward.
Thanks, Eileen. And I think Mari's already made the point that this is a very important distinction from a stakeholder point of view in Japan, but as an example of a jurisdiction. So I take comments, Lynn, Lucy, and then Camilla.
So I guess the important thing for me is to continually remind ourselves that performance obligations are a subset of present obligations. So, and on the revenue side, I felt that where we'd got to is this subset might benefit from more precise accounting, and that's sort of, I think, where we had landed. But actually, on the expenditure side, I think the important thing is to agree the principles at a higher level for all obligations before we then decide is then a more precise accounting for this subset useful on the expenditure side or not. And that's how I think I would prefer approaching it, by continually reminding ourselves this is a subset. And so let's agree the overarching principle first.
Thanks, Lynn. I think that's a very helpful way of thinking about it. And I see other members supporting that, so thanks for that. And I think that's an instruction to staff then that's a way forward that we think our way through on the basis of present obligations, and then is there something incremental for performance obligations? So I'll go to Lucy and then Camilla and then bring Ross in.
Yes, thank you very much, Chair. I think we have to rethink our position on retaining revenue from performance obligation as a separate type of revenue, although the accounting treatment will differ from those without performance obligations, because there are jurisdictions where revenues are classified as to nature of revenue, and perhaps having a separate revenue type might confuse our constituents. For example, income from grants and donations may also arise from transactions with or without performance obligations. So we're just using one account, for instance, one revenue account that is income from grants and donations. And this can arise from transactions with or without performance obligations. So I agree that maybe we have to deepen our discussion on this matter. Thank you, Chair.
Thanks, Lucy. Camira, and then to Ross.
Thanks, Chair. Yes, in relation with the performance obligations, again from FOCAL, they consider that for the transfer expense, it was not useful, this distinction first, because they consider, yes, that is in minority of cases. Second, yeah, because basically for them it's more important to know if those transfers that they do are subject to a refund or repayment. If not, then they say the accounting treatment is different. And secondly, because in the exposure draft 72, we are including this condition that in order to be able to recognize this as a performance obligation, the transfer provider should be able to monitor the fulfillment of those obligations, and many constituents in Latin America said we are not able to monitor that. We in best of cases we obtain some accountability reports on how they expense the money, but we are not able to monitor. We do not have capacity to do that. So in that case, for them, they say in that case for performance obligation, this distinction is not useful or not relevant. Thanks.
Thanks, Camira. Ross, and then to Patricia.
Yeah, actually, I think Camira just made a few of the points that I wanted to make, and I think it's important, building off Lynn's comment, that we take the approach of looking at the present obligation and then the subset of the performance obligation. But I think it's also the context of what we heard in the flaws with ED 72, where we flipped the accounting model, but we weren't consistent in flipping the principles. So that's why we have a problem we're dealing with now. And I think it's important that we don't lose sight of what constituents told us. Camira's just highlighted some of those points and why we need to look at this and how we look at it. So what's proposed in the paper is really just that we're having a consistent principle on the transfer expenses side, and we think can work that through. But I think it's also important to keep in mind that we have different perspectives when you're accounting from revenue, from the revenue perspective, and different perspectives from transfer expenses, and we shouldn't necessarily jump back and forth and take those perspectives and apply them to the other transaction, because I think you're in a different position. So there's some nuance here we need to make sure we don't lose as we work it through, and we've got to be careful not to overreact from something on the revenue side and jump to a conclusion that means something on transfer expenses, because it doesn't. But we need the concepts to be the same. The constituents have told us that. They weren't in ED 72, in ED 70 and 71. That's the problem we have to remember we're fixing, and not try and reopen everything, because if we do that, it's all going to fall apart.
Thanks, Ross. So, Patricia?
I disagree with the proposal, the staff proposal, because I think the focus on in the document, the arrangement, not the perspective of the entity, if as a recipient or as a transfer. For example, federal government here in Brazil can be recipient or can be transfer. And it's so difficult to, okay, now I analyze a performance obligation is important, and now it's not important. I think in terms of principle, what is really important in terms of principle is the obligation I felt when I analyzed the document that the direction was to have the same treatment for the entity as a recipient or as a transfer. Because this, I disagree. I think it's necessary to be aligned with the revenue. Revenue is aligned with expenditure expenses.
Thanks, Patricia. So I think, you know, coming out of your comment, I mean, that sort of reinforces the need for that conceptually we need to be consistent because of those flows and the, you know, between different levels of government and so on. I think, you know, that's where Camira's comments, you know, are important as well. The discussion probably rests at that present obligation level, and that I think is Lynn's point, and it's most helpful to go forward in terms of is there to have the discussion in the context of is there a present obligation, which I think addresses the points that have been made by other members, you know, in terms of people understanding this. Then there's this incremental issue about is there a distinction between present and performance obligations, and we need to take that forward in the context of revenue and to conclude the discussions in revenue, and then we can reflect back and see whether we see those principles that we've identified in revenue as reflecting back into transfer expenses. And we will need to come back to that, recognizing that you know, one of the things that this is likely to drive is the level of disclosure required, which is clearly where we were criticised for going at the level of performance obligations across all three standards, whereas people are saying this is overdoing it in the context of the transactions and so on. So we need to have, I think we need to bottom that discussion ideally in June on is there a difference, is there not a difference, so that we can then move the discussion forward on the disclosure side. But I think there's a clear exhortation here from members that, you know, from that point of view at the moment, we're focusing on present obligations going forwards and the conceptual consistency on the present obligation side. Okay. That's okay, Eileen? So I think we have one more issue to tackle. So we might finish off on that issue and then take a break at that stage. So Eileen, just introduce that final issue.
Mm-hmm. So this final issue is pretty closely related with the last one as well. So the decision that we had from the revenue project in March was that in terms of measurement, where there's a portion of consideration that relates to the transfer of distinct goods or services to the transfer provider or third-party beneficiary, then that transaction price should be disaggregated, and the components related to the transfer of distinct goods or services should be accounted for using ED 70 and the remaining components under ED 71. In cases when portions are unclear, then we would apply ED 71. The implication for transfer expenses will depend on this future discussion that we will have on the distinction between performance and present obligations, and also taking it back to that principal level to make sure that we are consistent on a principal basis. So the issues are definitely relatively interrelated, but we did want to flag that this is a potential implication that we will need to take forward as we continue the discussion on this item. So the question for the IPSASB is whether you agree that this will require further analysis and that it is related to our ongoing discussions on the transfer expense accounting side for performance and present obligations.
Thanks, Eileen. And I think actually that I see thumbs up on that, and I think the discussion that we've had did underline that quite clearly, that that's the direction that members see both in this debate, but also coming out of the March debate. Okay, so I think that with that we're through that item. I think that's been very helpful. Eileen, just wrapping us up on that.
Yep, so there's one more slide that we just wanted to run by the board in terms of next steps. It shouldn't take too long, but let me just quickly share my slide here. So as per the paper, there were quite a few next steps that we have listed on how we can tackle the list of issues raised by constituents, and that's just right above table 1 in the paper. Now, the two things that we wanted to run by the board and get your direction forward on are specifically the two listed on the slide here. So one, to first address issues related to principles first, which is the same approach that we have taken in revenue, and also to get your go-ahead on addressing the issues that we've discussed today using the takeaways that we have from the implications discussions on the principles from revenue project and how they're going to apply to transfer expenses here today. So we're looking to hear whether board members agree with the approach that's outlined in the paper. And if so, it's very appreciated, and we'll make sure to take that forward through the next steps in this project.
Okay. So principles first, and then we take into account the discussions. I think that sort of underlines everything we've been doing today. I see thumbs up from members for that. Good. Okay. I think that's been very helpful. Good first discussion. So at that point, thank you, Eileen. We take a break for 10 minutes now, and then we'll come back and then we'll look at executory contract accounting principles and whether those will help us going forwards in both sides, actually. So see you back here in 10 minutes. As ever, David will keep time for us and give us a 1-minute warning before we come back. I have a thumbs up from David for that. Okay, thanks. See you in 10 minutes, everyone.
Bernard, do you just want to come online to test your audio?
Yeah, let's test it.
Oh, perfect.
Of course, it works now.
Yes. Okay, great. No problem.
All right, so I'm not going to touch it anymore.
Okay, that works well. Okay, thank you so much.
Thanks, Leah.
1 minute warning.
Okay, so if we can take a check on who's back. Good, everyone coming back. So we're now moving into the next item on the agenda. And I think Paul is probably familiar to many members, but not some of the newer members may not have met Paul. Paul used to be a member of staff for the IPSASB, and as in that capacity played a key role in drafting ED 72, and is now working as a consultant. And one of the things he's doing is supporting staff during this next phase of the project. So in that support role, Paul is actually going to share with us some thinking that you know, staff feel may be helpful in taking this forward and dealing with some of the tricky issues that we're facing. So with that, Paul, hand over to you.
Thank you, Chair. So we're looking this session at executory contract accounting principles, really building off some of the discussions that the board's been having in its previous session. So if we look at particularly some of the respondents' comments on the next slide, what we're looking at here is there were some concerns expressed by constituents in the responses to ED 72, and particularly in respect of transfer expenses with present obligations. So we're going to have a look at some of those which we noticed, or staff noticed, actually are consistent with some of the issues raised by recent IPSASB decisions. So there is an overlap between the feedback we got from respondents and some of the decisions the IPSASB has taken recently. And do just want to emphasize that we're looking here at transfer expenses with binding arrangements, and particularly where they impose present obligations on the transfer recipient. For transfer expenses without binding arrangements, there was generally, constituents were generally happy that the proposed accounting treatment, i.e. you recognise an expense once you transferred the cash or had a liability to do so, that was generally accepted where there was no binding arrangement. So it is really just looking at those cases where there is a binding arrangement, but no performance obligation. So the first issue raised by respondents was that a number of respondents said, actually, the transfer provider has a right to a refund if the cash is providing in advance. And we've talked about that already in the previous session. So that relates to the IPSASB decision. Binding arrangements are always enforceable, and constituents were seeing that right to a refund as being part of the enforceability arrangements. Again, that was discussed earlier. The second issue, related but slightly different, was that transfer provider has an asset if the cash is provided in advance. And again, that relates to some of the relevant IPSASB decisions. First of all, binding arrangements always include that present obligation, and that enforceability, one of the points that was raised as a staff takeaway, enforceability suggests there is an asset for the provider. And staff's overall impression of these comments from respondents and the decisions is that there's a view from a number of respondents that the provider retains control of resources until the recipient satisfies the obligations that they have under the binding arrangement. I think related to the discussion we had previously, there are different views as to whether, as to the actual exact nature of that resource, the exact nature of any asset that the transfer provider may have. But there was a view coming forward from respondents that there is some sort of resource or asset controlled by the provider. So I think we're happy to take any comments on this at this stage.
Thanks, Paul. And as you say, quite a lot of resonance is there into the discussions that we had before the break. Lynn.
So just when you were presenting them, Paul, when you were describing present obligations, you described them as present obligations on the transfer recipient. And I guess the challenge is to think about all of this from the transfer provider's side. So I guess a word of caution in being careful on what we are meaning when we are using the term.
Thanks, Lynn. Go to Chris and then to Mike.
Thank you, Chair. I know we have mentioned this before on the kind of assets that we make reference to in our past discussion. I just want us to take along with this, take this along on that discussion. When we are saying that the asset provider transfers cash, we make specific example as of an asset as in cash. What if it is not cash that is an asset that is transferred? What if it is a good? How do we consider that?
Thanks, Chris. Paul, do you want to just come back on that before I go to Mike and Lindy?
Thanks, Chair. Yeah, I think whether you're transferring cash or transferring a good or maybe a fixed asset, the principles are the same. You're transferring something to another party, and if there's a binding arrangement, then in order to earn the revenue from receiving that cash or good or asset, the other party has to satisfy their obligations before they've earned the right to recognise revenue from that receipt. So whether it's cash or another asset or goods doesn't make any difference.
Thanks, Paul. And I think that's a good point, Chris, to bring that out, because it could well be an item of equipment or some form of aid or something like that. So it's helpful that we need to clarify that could apply across all those categories of asset. And I think that's one thing, if staff can take that away, that we do need to be clear that this would apply, not just to cash. Mike and then Lindy.
Thank you, Chair. So thank you, Paul, and thanks for sort of cross-referencing previous decisions. I found that helpful in your slides. Thank you. But for me, I accept that the resource provider has got a resource, has got an asset. I'm not sure what the nature of that asset is, though. And it's going to depend on the agreement. It may be a return of cash, but it may not. It may be super specific performance. And I think that's another matter we also have discussed in the past. So it's important to understand what the nature of the asset is.
Thanks, Mike. I'll go to Lindy and then back to Paul.
Yeah, and I think it's linked to Mike's comment. Is if it is a right to have the cash refunded, if I looked at IPSAS 41, and for an entity to recognize a financial asset, it talks about having an unconditional right, or a legal and an unconditional right to cash. And I'm not too sure if just because I've given the money, it meets that. So I do wonder if we need to explore that, or if we're saying this is something different to what you would recognize under IPSAS 41. And then, as Mike said, is it then something that embodies service potential? That we would then have to explore the circumstances. So I do wonder if the timing might be a little bit different, or if the value thereof might be a bit different, but I do think we do need to explore the nature of it and how we arrive at this. Thank you.
Thanks, Lindy, and I saw other members endorsing that point as well. Paul, do you want to pick that one up at this point in time, or is it something that we should hold for now?
I'll briefly touch on it now, but it will come out, or that it will be coming out in later slides. I think we do need to do further work on this. As Eileen said, we are planning to do a further paper on the nature of the asset that the transfer provider may have. It may, as Micah said, it may be something to do with, the right that you have gives you service potential. It may be the right to a refund. It may be a combination of the two, or the nature of the asset may transform at different stages of the arrangements. And I think we do need to explore that in more detail, and it may actually vary across jurisdiction as well. So I think it's clear that there will be more work to do on this, and it may drive some of the certainly some of the drafting, but also it may mean that how it's applied in different jurisdictions may vary depending on how the principles meet their specific circumstances. But at this point, we're just trying to focus on the high level principles.
Okay, thanks, Paul. So go to Adrienne and then to Ajith.
Well, Paul has just said we'll come back to issues that may vary by jurisdiction, and this is one of them. But I think it's general enough to mention it at this stage. It comes back to my issue of us taking into account the nature of appropriations. So in most, I would say most jurisdictions that I know about, appropriations are annual. So the question would be, imagine there's an appropriation for money to be given, and then the money's not given and the appropriation lapses. What happens to the asset that the other party is holding as a claim on the binding arrangement? Does the asset just lapse and disappear because the appropriation has lapsed? So I worry about in some sense, us staying consistent with the superstructure of the whole budgetary framework and the legal system for the budget. Thank you.
Thanks, Adrienne. I mean, I think the whole point about appropriations is really tricky, because inevitably, as we found out, they vary, in overall approach and in nuance between different jurisdictions, and so therefore, whether you have an obligation and the nature and timing of that can actually be very, very nuanced. So can we hold on that one for now, if that's okay? Because I think we are going to have to come back and have a specific session on how all this fits with appropriations, to make sure we get that right from both sides. So if we can hold on that, but if that's, I think we should have that instruction that we're going to need to come back to that. Ajith, over to you.
Yeah, thanks, Ian. When the transfer provider provides the resource to the recipient, and that provision of the resource is for the purpose of a performance obligation, and the performance obligation is a service that the transferor needs to make, or needs to provide, then I believe that it is an asset for that transferor. And the nature of that asset, I believe, is the ability to get that service done, and the value of that service is what I see is as an asset. But there's another aspect that I would like to address. Now, we prepare separate financial statements, we prepare consolidated financial statements. Now, when we prepare consolidated financial statements, I believe when a resource is provided to the recipient, and the recipient is doing something that is the consolidated whole is required to provide, then it forms an asset for that consolidated entity. But what is the situation if, when we prepare separate financial statements and the transferor has that service obligation, as well as the transferee also has that service obligation? Both parties may have the same service obligation, but who accounts for it as an asset is an issue that I think we have not looked at so far, because when we do separate financial statements, then the transferee needs to recognize that as its asset if the service is provided by that entity, and it is an obligation of that entity to provide. So therefore, transferee needs to recognize that as an asset. But should the transferor in that case also recognize as an asset in its separate financial statement is a different issue, because you have now given that resource to somebody else who also needs to provide the same service, and is preparing separate financial statements, and those separate financial statements need to reflect separately the assets and liabilities of that entity in relation to the service obligations of that entity. So I think we need to look at it, that aspect as well. Thank you.
Thanks, Ajay. So I think you're right in terms of drawing out the fact that we need to think about situations, because the guidance will need to apply to individual entities as well as to the consolidated position, and certainly in that context, it's likely that, for example, the previous discussion on appropriations will be relevant as well. I think, Paul, at this stage, I don't make the specifics, but I think there is a particular issue in terms of how we take forward that if we get the principles right, how do we essentially provide guidance on sort of individual entity versus consolidated entity? And that's something that maybe at this stage is perhaps better taken away as an instruction rather than trying to deal with it in detail. Paul, does that make sense to you?
I think so, yeah. A number of respondents raised the question about how you account for transactions where there are effectively a chain of public sector entities involved. So it's a grant from one to another, and then finally to the entity that's providing the services. So we do need to think about that. We also need to think about, depending on the individual circumstances, whether these are, subsequent entities are acting as principals or agents as well, because that it may be a principal agent issue.
Thanks, Paul. Yes, another layer that we need to think about, but you're entirely right on that. So actually, if we take that away, that there is that we need to think about how we address that. Adrienne, final comment, and then I want to move us back into the presentation.
Yeah, it's on Ajit's point. Once we move away from symmetry, we give up on having consistent consolidated accounts. So it's very fundamental. I mean, it's what we raised right at the beginning. Now, certainly in GFS, we confront that, and there is no answer to it. I know in the IMF, the way we've treated it is to go with to have a hierarchy where the treatment by the highest level of government rules is a symmetry that's imposed on the rest. Now, but obviously that's a workaround. So my point really is, yes, we'd be very interested in guidance, preferably guidance that solves this dilemma of you either have symmetry or you can't have consistent consolidated accounts. I don't know how we do it. We either go back to having symmetry or we have a workaround like the IMF does. Thank you.
Thanks, Adrienne. So I think, just taking a step back, all of this underlines that conceptually we need conceptual consistency in the guidance that we're developing. And I think then there is the specific that we need to cover off this issue in terms of sort of single entity versus consolidation. In doing that, though, I think we do need to cross-refer into the guidance that we provide that we already have. In IPSAS 35, I think it would be on consolidation. So that's where it's one of these issues where we need to be consistent within our suite. And if we've already given guidance, and I have to confess, I don't know whether we've given the practical guidance that Adrienne's looking for, but that whole who do you force into agreement is a very practical issue in terms of consolidation. So Paul, if you can sort of take that away as a, how do we provide that guidance? To what extent do we need to use what's already available in IPSAS 35 as an instruction that we need to make that, we need to address that, and that clearly reflects the comments made by our constituents. Okay, so thanks for those points. So Paul, take us back into just walk us through the presentation then.
So the next slide is looking at what is effectively the executive contract accounting principles. The IPSASB conceptual framework talks about executive contracts, but only in the basis for conclusions. It recognizes there are executive contracts, that they're binding arrangements, but it doesn't actually settle on how you should account for them. It recognizes there were different views at the time the framework was approved, and doesn't specify which approach should be taken. Since then, the IASB has updated its framework, which actually just provides some more details and perhaps a little bit more resolve some of the issues that the IPSASB had left open. So the definition, executive contract is a contract. For us, that would be a binding arrangement or a portion of a contract that is equally unperformed. So neither party has performed its obligations. Both parties have performed equally. And then some of the key principles, which is, I think, what might be helpful when we're thinking about the accounting for transfer expenses, but also for revenue. An executive contract establishes a combined right and obligation to exchange economic resources. The right and obligation are interdependent and cannot be separated, and hence the combined right and obligation constitute a single asset or a liability. So also worth noting that the IASB said when executive contracts for us binding arrangements are initially recognized, in most cases, the right and obligation are recognized at cost. That will typically therefore mean that the combined right or obligation is at zero. So generally, you wouldn't be recognising any item when neither side has performed. Maybe if we just drop the slide there and just check if there's anything anybody wants to add to that or talk about, or whether we just move on to a couple of examples.
Or what I might just do is, John's reminded me in the chat that this is one of the issues that we will address in the next stage of the Conceptual Framework Limited Scope update, and he's planning to bring a paper on this in September. But therefore, I think it's useful that we have the discussion as a preparatory in this session, but recognise that we have the opportunity through that to address, as you say, the fact that we did have a gap in the conceptual framework. And I think it's probably fair to note that, and I probably plead guilty as one of the members at the time, that I think by the time we got to sort of this stage, we were kind of like, we don't need any more issues. We'll just pass over this one at this point in time. So now's the time when we obviously do need to think about that. Can I take Lynn, then Patricia?
Thanks, Ian. So I've got no comments on the definitions and the slide that you put up, but I would like to draw attention to the equally unperformed element, because I think the papers then apply these principles to situations where you haven't got equal unperformance. So once you've transferred resources, you don't have equal unperformance. So I don't dispute the slide you put up, but and we no doubt will come on to it in the discussion. But once one party starts performing and the other hasn't, you haven't got an executory contract because you haven't got equal unperformance.
Thanks, then. So I'm going to take, sorry, Ross, did you want to come in at that point in time?
Just one quick point. I agree with Lynn's point there. You wouldn't have the equal in performance, but then you would actually be applying the accounting that would fall in place from the binding arrangement, because you would be into performing to the arrangement. So I think, and when Paul will get to that a little bit later in the discussion as well, but it's a good point. But it's, you know, when you do start performing, or both sides start performing, then you're actually into accounting for the binding arrangement, which is what ED 72, when it becomes a standard, will be telling you what to do. Thanks. Ian, you're on mute.
Sorry. So thanks. So Lynn, did you want to come back on that directly before I go to Patricia?
So I agree with you, Ross. I'm therefore a little confused from the papers as to what is termed in the papers executory contract accounting, because I would say that we are then into accounting for the binding arrangement once people start performing.
So I think there may be, you know, this is where when staff was sort of discussing this with me beforehand, I suggested that we talked about principles of executive contract accounting, because actually the context we needed to have the discussion in was a binding arrangement. So it wasn't that you would substitute executive contract, that it was actually just that you would look at principles and see if those applied in terms of how we try and clarify the accounting around binding arrangements and the accounting principles. Or the accounting approach to that. I've not confused things by suggesting that that was the approach we took. Is that okay, Lynn?
I think I am confused, because I think the papers led me to be reading an assumption that the arrangements we were accounting for met the definition of executory contracts, where they clearly don't. So I'm not sure it worked for me in the papers.
Okay, so Lynn, perhaps the best thing to do is to suggest that we carry on through the discussion, because I think that was where I tried to steer staff away from introducing executory contracts per se, but just say that in developing this, in the ISB developing this concept, that may help us with how we deal with binding arrangements. So it's more by analogy than that actually we're saying this is an executory contract. So if you're okay on that, to hold on with that and see whether that helps you. I think, you know, in the discussion, I recognise we're not necessarily going to get to the end, but the question was where what came out of the debate on the way, if you like. So if I can go to Patricia and then Ajith and then Todd.
Thank you. In relation to the conceptual framework limited scope project, I'm concerned about the alignment with the project, because the executor contract will also be a subject of the project, and the conclusion about the definition may be different. For example, considering the specificities of the public sector, the conclusion may be that may be different in relation to single assets or liability, or in relation to exchange resource. I think the term exchange economic resource may not be adapted for the context of public sector. In connection with the discussion about the nature of assets, sometimes the transfer provider maintain the control of the assets, but not expect to receive the money, return the money. Then I think we need to be careful, and it's necessary to align with the discussion in the scope of the conceptual framework. Thank you.
Thank you, Patricia. Go to Ajith and then to Todd.
Yeah. Thanks, Ian. Yeah, my understanding on this issue on executory contracts is that this will apply when there is a binding arrangement, but neither party has performed. So in that situation, I think when there is a binding arrangement, but neither party has performed, then I think the executive contract principle will apply. But of course, we need to consider one aspect, that is, what would happen if only one party is required to perform. For instance, one party is required to give a grant to another party, but the grant has not taken place yet. And the other party doesn't have to do anything. I think that situation also need to be addressed, but it's a bit risky to take it before it is performed. But still, the principle needs to be established, and I think we'll need to address that issue where only one party is required to perform. That is, one party is required to provide a grant, the other party is willing to accept the grant, and so there is only one party that is required to perform. So in that situation, how this principle will apply and how we're going to use that in our standard.
So Ajith, can we pick that one up when I want Paul to walk through the examples in the paper, and then can we come back and just reflect on how that fits with the situation that you've just described? So if we can go to Todd next, and then I'll ask Paul to go back and talk about the examples, because I think that might help.
Well, thanks, Ian. I think we established earlier that a binding arrangement is quite a fundamental concept in terms of what we're dealing with here. And the executory contract accounting principle only works with the binding arrangement, so happy with that. When dealing with the executory contract principle, equally unperformed on both sides. I think it would be helpful if we do clarify that where we've got that situation, there will be no accounting. So I think, given that we want to start with this concept of binding arrangement and it's quite fundamental, I think there is probably a place to reflect the fact that if you've got a binding arrangement and nothing's happened, that you don't do accounting until you actually get into one party starting to perform, and then you're into the more substantive part of the standard. But what it raised for me was we are going to have to think about the disclosure side of that, I think. So if we're going to be starting with binding arrangement and executory contract accounting, which is no one's recognising anything, we're going to have to think about the disclosure side.
Thanks, Todd. Paul, anything you want to reflect on before we go into the discussion of the examples? I mean, I think that point that Todd's made about disclosure actually is an important one, and certainly members have supported that.
Yeah, I agree. We will need to think about the disclosure requirements once we've agreed how the accounting is going to take place. Going back to the situation where you have an arrangement where one party is required to provide a grant, but there's no obligations on the other party to do anything for that grant, that wouldn't meet the definition of a binding arrangement that we have within ED 70 to 72. It certainly would be an obligation on the transfer provider to provide that cash, but it would be treated as a transfer expense without a binding arrangement for the purposes of ED 72. So we wouldn't be talking about executory contract accounting principles in that case. It would simply be you have a liability to transfer the grant.
Okay, thanks, Paul.
Okay.
So if you take us back into the examples and just,
yep.
I think if you take us through the next sort of 3 slides, and then we'll come back and see what observations members have at that stage.
Okay, so we're starting with scenario 2, linking this back to the examples in the appendix to the paper, because this is probably the example that is most common in a lot of jurisdictions, which is where the transfer provider provides the cash up front. So we start off, we have our transfer recipient, our transfer provider, enter into a binding arrangement. And the first obligation is that the transfer provider has to provide that cash to the recipient. So if we were recognizing obligations, so you have an asset for the transfer recipient, or a right, an asset for the transfer recipient, which is that right to receive the cash, and a liability, an obligation on the transfer provider to provide the cash. The second obligation within the binding arrangement is the obligation on the recipient to deliver services. So that's a liability, an obligation, a liability for the recipient, and a right and an asset for the transfer provider. And at this stage, the binding arrangement is fully unperformed. So effectively, if we were to apply principles, you would say we have a right and an obligation on each side that are intrinsically linked, can't be separated, and therefore you would recognize a single item. Generally, that will be measured at 0. And to go back to Lynn's point, this is the stage at which you would be applying effectively. This would be an executory contract in terms of the definition in the IASB conceptual framework. Subsequently, you'll have the performance by one party, and in this case, this scenario, we're looking at the cash being transferred by the transfer provider. So the arrangement is now partially performed. This means that the right to have cash transferred to you, the obligation to transfer that cash, disappears because that obligation is now performed, it's not unperformed. So the transfer recipient recognizes an asset for the transferred cash they've received, the transfer provider will recognize a decrease in the cash that they hold for the amount that they've transferred. That means that the obligation to deliver services, which may now also include an obligation to deliver a refund, still exists. It's still in the part of the binding arrangement, still unperformed, but there's now no other unperformed asset that it's linked to. So you also have to recognize this. So that would be a liability for the transfer recipient and an asset for the transfer provider. Did you want to stop here, Ian, or move on to the second example?
I think maybe do the second example, Paul, and then we'll pause and ask members for questions at that stage.
Okay. So the second scenario, which is scenario 1 in the papers, is the opposite approach, the same binding arrangement, but in this case, it's the recipient who performs first. So the recipient delivers the services. Again, the binding arrangement is now partially performed. And so the right to have those services delivered, the obligation to deliver those services no longer exists, and instead, transfer recipient recognizes revenue because they've earned that revenue now by delivering the services, and equally the transfer provider, the services they've entered into the binding arrangement to have delivered have been delivered, so that's now an expense for the transfer provider. The obligation on the transfer provider to provide the cash for those services still exists, so that's now an asset receivable for the transfer recipient and a liability payable for the transfer provider. So we just check if there are any questions at this point.
Cool. Yeah, Tricia, go ahead.
Thank you. It's not a question in relation to the what you present, but about why the owner's contract is not considered in the paper, because in this case, one asset or liability can be recognized in the beginning of the commencement of the contract. And then my suggestion is to include the owner's contract in the discussion. And I think another point is related to discussion about the present obligation. I wonder about the use of the term present obligation because of the definition presented in the conceptual framework. Obligations are not present obligation unless they are binding and there is little or not realistic alternative to avoid an outflow of resources. And in this case, when we use the executory contract principles, the present obligation appears only when one part fulfill the term of the contract and the other part not. The contract is no longer executory. So the affirmation that there is at least one present obligation in a binding arrangement, I think it's needed to be clarified. So my suggestion is to clarify the relationship between binding arrangement obligation and present obligation in accordance with the executory contract principles.
Thanks, Patricia. So, Paul, if you can go back on the onerous contract point, I think the terminology point we might need to log at this stage, Patricia, and come back to that because it's one of these ones where there's a number of different things, and I think there's some discussions to have elsewhere that we need to have before we circle back on that. So that might more be an instruction to staff actually, but Paul, on the onerous contract point.
Yeah, I think we will need to come back to onerous contracts at a later stage and what we mean by those. IPSAS 19 does say that if an executive contract is onerous, then you recognise a liability immediately. However, in previous standards, the IPSASB has said if you are contracting to provide something and effectively you're not going to fully recover the costs. And the example I'm thinking of is IPSAS 11 construction contracts. So what IPSAS 11 says is if you contract to provide buildings and you are doing that at less than full cost recovery, so you're not going to get full amount back, or you may even be providing it at no cost. If the intention when you enter into the contract is not to have full cost recovery, then it's not an onerous contract. So I think we will need to come back and decide. Yeah, I take the point that we should be recognizing onerous contracts as a liability if the contract is onerous, but the IPSASB will need to decide what it means in the public sector, in the context where you have effectively non-exchange transactions, about what is an onerous contract. Is it an onerous contract if the intention is always to provide a grant? Because or is it only onerous if it's going to cost you more than you had originally intended? So I think that's a debate we will need to have. In the past, looking at IPSAS 11, the board's decided, well, if the intention is to provide a grant, then that's not onerous, that's the initial intention of the contract.
Thanks, Paul. So I think there's two instructions there. One is that we need to come back and look at onerous contracts again when we've got a bit further. And the second is also that we will need to reconsider terminology just when we've actually got through further. Okay, so I've got 4 hands up at the moment. So I'm just going to take comments from those members in sequence, and then we'll go back to you, Paul, to collect responses to those. So I've got Camira, Bernard, Mark, and then Lynn.
Thanks, Chair. I think these accounting principles of executive contracts could work depending on who is the transfer recipient. For instance, if the transfer recipient is from the private sector, there is most possibilities of enforceability from the public sector entity. Or also we could consider in terms of enforceability the fact if that transfer recipient, it belongs to the same reporting entity in terms of consolidation, because that might also be the case that maybe it will not be worse for the transfer provider to recognize an asset even if they transfer in advance the cash to the transfer recipient, because they belong to the same reporting entity. And if we even consider the figure of the treasury single account, at the end of the day, the resources are still in the same bank account, so there's no outflow of cash. So we could consider also that when writing further this exposure draft. So thanks.
Thanks, Camira. So Bernard, then Mark, and Lynn. And I'll go back to Paul at that stage, Lindy, just before we lose too many points.
Thanks, Ian. I hope my mic is working now. Perfect. Thanks, Paul. I think it always helps a lot to visualize those things. It really helps my thinking. And I just wanted to kind of clarify. In my mind, there will be initial recognition, right? So at some point in time, both parties would have to assess whether their asset is still valid or whether they have any option to void the liability, giving their rights and their powers. And I just wanted to add a point, but probably maybe it's too early because I don't want to blur the picture. But there could be, for example, that you will provide the cash on a payment schedule, which might not fit the performance of the obligations. So you might have a mismatch in those two. But again, I didn't want to go too early, but maybe ultimately I did, so apologies. But I think it's really helpful to see these things on a slide. Thanks, Paul.
Thanks, Bernard. So I've got Mark, then Lynn, and then back to you, Paul.
I agree to the recommendation staff made to this principle. So first of all, I want to say the paper is very well written, very well. It was very good to read, and thank you for that. And I think it's an important issue to discuss, because if you remember in the ED, we actually proposed to that as soon as the money is transferred, there is already the accounting starts. And obviously, coming back to the March discussion with the binding arrangements, where we say there could be a present obligation, we really have to question that. And I also think the paper lays that out very well, the rationale why, if I were have to talk about this executory contract, because this is when does the accounting start. And I think many arguments have been made. I agree with those members who also agree to the principle. So my full support there. But I also acknowledge that once we have agreed upon the principles, we need to start about talking about what's the nature of the asset. For example, is it the same nature of the binding arrangement asset has in the performance obligation approach, or is it different nature? We have to talk about disclosure. We have to look at how it does look with impairment. I fully agree, but as for now, I think if we can agree on the principles, and therefore I would like to show my support for these principles. Thank you.
Great, thanks, Mark. So, Lynn, I'll take your comment, and then Paul, back to you before I go to Lindy.
Thanks. Maybe I am a lone voice. I think we are in danger of using terminology that will confuse and complicate things. I totally agree with executory contract accounting when neither party has performed, but if we start using this sort of jargon and terminology, I think it will confuse our constituents. I think what we're actually saying to ourselves here is, on the revenue side, you get to recognize revenue when you've discharged your obligations. And then on the expenditure side, we have a decision to make about when do you recognize expenses still. The paper is suggesting to me that you only recognize expenditure by assessing your present obligation as being only that you have a present obligation when the other party has discharged their obligation. And that seems to be the principle that you are ending up with here. If that's the principle we are ending up with, then I think we need to use the language of how we define present obligation, how we assess present obligation, what is the past event? Is the past event only a past event when the other party has discharged their obligation? Is that what we want to say? But I think we need to use the language of expenditure and how we assess obligations. And I think using language like executory contract accounting does not help here. I think we need, to me, to look at when do I have an obligation? How do I determine what a past event is that gives me a present obligation that I have to recognize as a liability or expenditure? I totally agree with Patricia's point that we need to then say, when do I have an onerous obligation? I think we also needed to say, when do I have a constructive obligation? And we need to use that type of language in determining when we recognize expenditure. I just don't find a forced analogy into executory contracts helpful for me.
Thanks, Lynn. Paul, before I go back to other members who want to come in, I mean, just to clarify, I think the idea was to apply the principles for our own thinking rather than to include that per se in the guidance, you know, and therefore from a conceptual point of view, if we're going to pull on some of those principles, then that would be appropriate to mention that, for example, in basis for conclusions, because I entirely agree with you, Lynn, that we've got to use the language of, you know, the guidance consistently and consistent with our conceptual framework. Paul.
Yeah, if I build on that point first, agreed. I don't think we would be using the language of executory contracts in the actual standard itself. We've used the concept elsewhere in IPSAS, and it's always been about when you recognise the asset and how you measure it, never about, you know, using the phrase executory contract in the standards. It was used here really just to give the board the link back to the conceptual framework discussion rather than anything we would necessarily bring forward. Going back to Camira's points, I think we will need to take those into account, and they're probably going to come up in the enforceability discussion and nature of binding arrangements. So we will need to pick those up and discuss those. And then Bernard's comment around, which may be a little bit too early. I think it's, you know, yeah, for the discussion so far, we have simplified it to a single cash payment. There may be a series, and it goes back to the issue about, you know, whether you have equally performed or not. So if you've made one cash payment and that's been, you know, then you've still got a chunk of the arrangement that you've not performed and the other party hasn't performed. So you would effectively be partitioning the arrangement into a partially performed or into a partially performed part of the arrangement and an unperformed part of the arrangement.
So just before going into the next set of comments, I think I'm hearing some support, if you like, for the kind of accounting implications, particularly when neither side has performed. I think the steer that I'm getting from members is that trying to fit this into a model of executory accounting is not helping members to understand, and therefore is not going to be helping our constituents to understand. And so therefore it may be that actually it's better going forwards, actually stepping through this from a point of view of, you know, almost like the examples that you were giving there, Paul, which is what happens at the beginning when neither side has performed, what happens when you have partial performance, and there are a couple of different examples of that, and then what happens at the other end. Now, as Bernard said, you know, real life is going to be more complicated, but actually we need to satisfy ourselves on how this actually works. And at the moment, they're kind of putting the template of executory contract accounting on this is not helping members in terms of their understanding. So if I can then go to Mike and to Renee.
So thank you, Chair. You've summarised it as I was going to try and do. I agree with Lynn and Patricia. So I did find the paper confusing in that respect. So if we end up with what you've just described, then I'm going to be okay. Thanks.
Thanks, Mike. Renee?
Yes, hi. Thank you very much. I've been listening to the whole conversation, and I admit I am also confused. I have a hard time wrapping my head around applying the concepts to the types of transfers, common transfers that we deal with in practice. Maybe I thought it was because I'm coming in late in the project, or like Scott, I haven't really been thinking about the intricacies of the projects from a board member's perspective until now. So, just the one thought I want to share that maybe can illustrate the difficulties I'm having would be, I think what I understand from an executory contract is that you have equal performance and you would have similar performance obligations on both sides. And I think that's the starting point. But what about a scenario where the transferor would establish that making the payment, making the transfer, that satisfies their obligations, that's their obligation, notwithstanding the fact that the recipient may have its own performance obligation. So I would like us to think about, is that scenario even in scope of the current conversation? Because I totally understand that we need to go back to step one. Do I have a binding arrangement? Is there enforceability? But I'm still concerned that we would be recognizing an asset by the transferor when in fact the asset definition hasn't been met. And I know others have made similar comments. I just wanted to be on the record that I am struggling as well, like other members are. Thank you.
Thanks, Renee. I mean, I think that, that is exactly why we're having this conversation at this stage, is actually to try and, if the board can, if you like, understand the process and get its thinking straight, then we can write the guidance and we can persuade constituents. And I think probably bouncing off where you got to, in a way, it comes from out of the discussion that we had earlier, where members are happy with the centrality of the binding arrangement concept, and that enforceability is key, recognizing that manifests differently in different jurisdictions, that there is, that having a present obligation on the transferee, there will also be one for the transferor, and therefore what we need to do now is actually really articulate the accounting, bearing in mind the definitions in the framework in terms of what is an asset, what is a liability, and then we need to step through this, which is what happens at the beginning, which is the equally unperformed part, and then we need to probably build off the scenarios that you've articulated there, Paul, which depends on who starts to perform first, if I can call it that way, so that we have some situations that can arise in practice in terms of partial performance, and then moving it through to the logic, so that we have that picture in our minds as this is how it's going to work, bearing in mind how we've defined binding arrangement, bearing in mind the articulation of enforceability, and then what that means, building off the definitions in the framework. Now, where that lands us at the end of the day in terms of consistency and the need for, discussion on quotes executory contracts, and I'll call it quotes at the moment, in the framework, who knows, but I don't think we should prejudge that. And that discussion we won't have in the framework context until the September meeting. So I think the ask for the June meeting is that we do actually take what we've agreed elsewhere and then use that to work logically through that process in terms of both sides haven't performed, one side have partial performance, and work it through that way. Paul, does that make sense then in terms of moving this forward?
I think so, yeah. At this stage, we are just trying to get the broad principles agreed, and we can then look at how they apply in more detail. And I think what picking up is people are generally comfortable that when neither side has performed, there's no recognition. Once you perform, once one side has performed, then you've got assets and liabilities, and we'll need to do further work on what the nature, particularly on the transfer expense side of that asset would be.
Okay, and I think it will be helpful that we actually see that symmetry in terms of the concept, that conceptual consistency as we work this through, even although, as we know, how that might work out in practice will, is dependent on the actual circumstances and the parties involved. Adrienne and then Lynn.
Thanks. It's a comment on Renee's intervention, which I thought was helpful to me, because it brings it back to where I keep going back to. To me, the fact that we start by saying a binding arrangement is intrinsic to this whole discussion causes us to abstract from this broader consideration that this binding arrangement characteristic will be applicable to a very, very small number of transactions relative to all government transactions. And so we're writing a standard for a very small subset of potential transactions. Now, I'm fine with that. If the standard needs to be written, it needs to be written. But I think where we keep coming back to is there are going to be so many cases where the binding arrangement is not well-defined or enforceable or fits into Paul's framework. And so the standard will not be applicable. At least that's the way I'm understanding it now.
Adrian, I think you're right that real life is messy. That doesn't mean that the binding arrangement concept is not really important in terms of how we move ahead with this, because fundamentally, if you don't have a binding arrangement, then you have an expense that you recognise up front. And it's as simple as that. If there's a binding arrangement, then you have other factors that need to be considered. So I think, you know, what we're trying to do here is actually give people some tools. We're not saying this is how you have to construct your transactions, but what we are saying is if you actually want to control the way in which the obligations are met through the arrangement, these are the features that will need to be there. If not, it's just expenditure. And I think that's really what we just have to recognize. That doesn't take away from the need to do that, but you know, that I think that if we can go forward on that basis, that's good. So I go to Lynn and then back to Ross.
Thanks, Ian. So just, I guess it's a sort of thought about the next set of papers that come, because whilst we've said a few times everybody's comfortable that nothing gets recognised when no party has performed, we should not lose sight of you still need to make an assessment about onerous or not, because you could end up with something being recognised when no party has performed. So I do want us to not lose sight of that. And I also think we shouldn't lose sight of making sure that we have consistency from a principles perspective of when you recognise a liability in an asset, when you have a binding arrangement and when you don't have a binding arrangement. That's not saying the same accounting treatment, but we need to make sure that from a principles perspective, we are consistent and sound in the way we interpret things across situations. You know, so the way we interpret past event, for example, way we or obligating event. So for those scenarios where you don't have a binding arrangement, is it that you recognise the expenditure as soon as you make the announcement? You know, we've been through some of this discussion, or is it actually that you have to do something more than that? So from a principles perspective, we do need to make sure that we are consistent, and it's a plea for when the papers come back next time, can we make sure that we are rooting the language around the definitions of assets and liabilities, etc., that we've already got, so that we use that consistently across. And then, sorry to be really long in my comment, I guess my final question really was, I know we were revisiting in Q2 the need for a task force on the revenue side. I'd lost track of where we'd got to on task force or board sponsor for the expenses side of the project, and do we need to give that some thought?
Can we take the project management separately, Lynn? Because I think the answer is no, we don't need to separate the elements of this project. That was where we went wrong first time round. We need to look at this holistically, and how we do that and the right vehicle for that is something that's still, you know, out for debate, to be honest. But I think, you know, what comes out of the discussions we've had today is the importance going forwards of actually conceptual consistency with how we're dealing with this, which we didn't have first time round, and part of that was the piecemeal way we did it. So we need to go top down, and we need to work out at what point does top down stop, and we need to and we haven't got there, frankly, at the moment. So we haven't or there isn't a sort of view, if you like, on at what point and what vehicle we might use going forward. So if you're okay with that, we'll park that one for now again. But on the consistency point, I think that point has come through loud and clear, that the definitions that we're using and the terminology use has to be entirely consistent, and that would be absolutely consistent with what our constituents said to us in a number of places. Be clear. So I think that one's come through loud and clear. We are at the end of the session, so I think, Liz, if you're okay, I'm not going to take your comments at this point. I just want to go to Ross to wrap up, and then there is a point that Dave wants to make. Thanks, Lucy, for being with me on that.
Thanks, Ian. And I think it is a really good discussion. I think the one point I wanted to make that we shouldn't lose through this is we are moving from the ED stage to finalizing a standard, and we've received positive and negative comments. So we're focusing on the one big issue that came out in this discussion about the split we proposed in ED 72 between accounting for transfer expenses that relate to a present obligation or a performance obligation. So in some of the comments that have come up, we've come to the issue of how you account for non-binding arrangements. Well, we had proposals in ED 72 on this, and those were supported. That's why we're not discussing them again. As Ian highlighted, it's pretty clear we don't have a lot to do there. Depending on what we do in the binding arrangement and the wording there might be knock-on effects. But the reason we haven't brought the board drafting yet is we want the board to agree the concepts. Then the drafting will come back and we'll go through. So that's very much in the plan. Lynn, to your points, all of the points you've noted are on the docket to come back, and they will. But first we need to agree what that principle is. So that's why this discussion was brought in this way, and these concepts are brought through because they actually exist on the revenue side and underlie the revenue accounting already. So we're taking that thinking forward and what it means when you sign the agreement, but neither party started to perform. That's been a big issue. That came through the comments. So that's why we're addressing it. So I did think bringing it back to why we're talking about this is important, and we shouldn't lose sight of that. This isn't the beginning of the project. We've been through a CP. We had responses. We responded. We put EDs out. We've had responses. Now we need to respond. But we're not rethinking the whole model from square one. And where we've got support, we should build off that in the drafting and take it forward. I just thought it important to bring it back to what we're actually trying to achieve here.
Thanks, Ross. And I think, the request to staff is keep bringing it back to what constituents have supported so that we remember that. And then what are the issues that we're trying to address. But I do think that the comment that's come through loud and clear is that comment that Lynn re-articulated then, is that we have to, and we were criticised for this, is be entirely consistent with terminology and the way in which it's used elsewhere in our suite, both the framework and in other standards. We have to be rock solid on that going forwards. So I think with that, I'm going to wrap up that item. I think it has been very helpful to have that first discussion because I think we have got some ways forward. I think it's clear that as we deal with each of these specific elements in terms of drafting, for example, on binding arrangement, enforceability and so on, we need to see what's intended in terms of the drafting on both sides of this, on revenue and the transfer expenses, so that the board can see that going forwards and we can see the conceptual consistency. So that has been a really helpful discussion. Dave, I just wanted to pass over to you just for a process comment in terms of what's going on and expectations over the next few weeks between now and the June meeting on the work programme consultation.
Thanks, Chair. And I can be fairly quick on this. I just wanted to update members that coming out of the March breakout sessions where we discussed prioritization of projects on the mid-period work program consultation, we've had a task force meeting where we've started to prioritize, and the good news coming out of that is there was lots of consistency coming out of the breakout sessions and through our own internal project prioritization and through our regional roundtables that we revisited from a few years ago. Now we're at the stage where we've developed our first draft of this consultation. It's going to the task force later today or tomorrow. And the big process for all members, observers, and technical advisors on this call is to watch your inboxes, because I'll be sending out a meeting request either later today or tomorrow for a May 17th or the week of May 17th, where we'll reassemble the breakout sessions to discuss a very high quality version of the draft consultation paper so that everyone can see it in advance of the June meeting. So that's the big takeaway. And then coming out of that May 17th week, we'll finalize so that the board can see a final draft for the June meeting. So Ian, I'll turn it back over to you.
Thanks, Dave. So really, as many, we really do want people to input to those, those second breakout sessions. The first was really helpful, and that really helped the task force, I think. The other thing just to say is, in parallel with the task force breakouts that week, there will be a discussion of the same material with the CAG as well, to get their input on that before we go into the June meeting. Okay, so thanks very much everyone for your time today. That has been, I think, a useful discussion. It has been helpful having a bit more time to get a sense of what's working for board members, what's not working for board members. And I think there's been some good inputs there. Thanks, staff, for the papers and for the presentations. I think those have helped us elucidate, again, where we have agreement, where we have challenges. And I think that sets us up well for the discussions that we'll have in June. And there will be plenty of time for discussion on this in June. It is one of our major items for the June meeting. Good. So I think with that, wrap up. Thanks everyone, good to see you. Do please stay safe between now and the June board meeting. And look forward to seeing you all at varying points in between. But thanks everyone for your input for today. Thank you.
Thank you.
Bye.